Welcome, everybody. This is the first in a series of YouTube videos that we at the Monetary Frontier plan to be doing that walk through some of the logic for our views around the US macroeconomy. So today we wanted to talk about our views on the various impulses that are flowing through the US economy right now, as well as what that means for assets and what that means for risk-free rates. So with that, let's just get into it. So the first chart we have here is one that George has been posting a few times recently, showing and relating the various impulses to each other. George, do you want to just give a summary of what the point you're making is here?
Sure. And thanks for giving us some time. You can find us, of course, on X and also via the Substack, the Monetary Frontier. The ability to do so will be on this YouTube channel. We hope to do a lot of these going forward, and we hope we have good utility. And for Riddick's sake, I hope eventually we make some money on this. But for now, the utility is the prime driver. Riddick, I wonder if you can free up my cursor here.
Let me do that. Remote control. Okay, you should be able to move it.
Okay, we've if you've been watching or following us, or if this is your first time you came across us, we've spent a lot of time for the last couple quarters on the fiscal impulse, the monetary impulse, excess savings, which we see as the results of the fiscal impulse, the total impulse, which is the monetary impulse and the fiscal impulse. And then we try to relate it to what the cumulative NGDP has been since COVID. And this is all since COVID. And the NGDP is what it's all about. I mean, there's not much use to going through all this contortions and analysis unless you end up with some sort of idea of what NGDP has done, why it is done, and then also why NGDP will likely go ahead and do something. So anyway, you can see this is how this all maps out is most people are pulling one side of the elephant. They're either feeling the tail or the trunk or the hide of the side and saying, this is it. We think that you have to take in all the impulses and change to understand what is going on with NGDP. The big story is that since COVID, the US federal government has really poured into the economy at levels and size that hasn't been seen since World War II. That seems to be overlooked because most people have to overlook that fact just to come up with make any sense of what they keep saying over and over and over again, which is misleading and likely rubbish. If you consider the size of the fiscal impulse, and here you can see right here's that purple line right here, is that after a week or so of CARES Act, it was up to 500 billion putting into the market, and then it went onwards so that by CARES Act 2 in February of 21, we had gone to like $4 trillion was poured into the US economy. It sort of leveled off as the various FUPC, the unemployment insurance plan, also as PPP wound down. It leveled off, even went down a little bit, but not that much, just to 3 trillion 5. Now, some might say, well, this leveling off might heck, that means the economy is going into a recession or a downturn. It is 4 trillion. It is 3.5 trillion. That is a phenomenal amount of money, which can't be digested in this time span from April 2020 to March 2022. So, and further on, it is actually increased as Biden added all sorts of acts that are not necessarily related to the COVID, Inflation Reduction Act, the CHIPS Act, and so on. And we've gone right back up to the heights of 5 trillion, and we're actually still gradually rising. This might be considered a normal US government fiscal spend, almost getting back to the normalcy of mandatory and discretionary, leaving the emergency aspects behind us that started this all, but still very, very strong. Why? Because the US economy is like a $28 trillion economy now. And It did falter with COVID. Now I'm going to the brown line, which is NGDP cumulative. That means that this right here is 3 trillion loss to December of 2020 in NGDP. We can't get an accurate time, value that we can forget these, because we lift this all from the monthly Treasury statement, which is publicly available and assumed to have great accuracy. It does have great accuracy. But this we have to pick up from the BEA monthly releases, and then of course the GDP release, which we're going to get the first for fourth quarter 2023 in a couple of days, on Thursday, I guess in a day. So COVID did impact the close down of the economy, did hit the U.S. economy, a very severe 3 trillion. That's a very large amount, almost assured of a recession, if not sort of a GFC type of possible depression. And then from the lows of, let's say, 3 trillion to currently 2.5 trillion, it has done a massive, which dwarfs all the other values, by the way, a massive 5 trillion improvement in a very short time span. And this is, of course, is the 6% at 1.7%, but definitely around 6% NGDP economy that keeps on trucking. This is in terms of economic history, this is very large. And again, at the monetary frontier, we're sort of stumped why this isn't like the main act. Like why aren't people doing all their numbers? Like there's a monetary cycle, it's going to tighten, it's going to ease, all the stuff that goes on and on. Why don't they mention this phenomenal historical event that we're now seeing right now? And then the green, everyone's focus right now is the Fed. We've been all trained to be so since Volcker in 80, when he started the 81, 82 Reagan recession. We got to, it's the Fed 24/7. And that made you a good living. And that also made you a good understanding, because this fiscal impulse was as it is here in the tail. It was all locked into a mandatory and discretionary sort of wrangle. It worked, actually, which made this a very predictable rise on an ongoing basis. But the monetary was, and we have some other charts which you can find on the monetary frontier, was pretty well always either way above this or below this, although it was only in amounts of 1.5 to 2 trillion. And you can see right now that it's far less than that even. And if you look at the monetary impulse, not what the Fed says they're doing, not what they say they promise to do, not what all the pundits say, that's obvious the Fed's doing this, the Fed's doing that, reverse repo facilities, bank lending facilities, all the emergency stuff from coming from Silicon Valley, et cetera, et cetera, et cetera, et cetera. The reality, which we see as what is the actual money creation that the Fed is supervising and allowing the banks to do, or telling them to pull back, and that comes from monetary. That comes from the loans. That is in every week it comes out with a new number in terms of how much loans the system bank is creating, or has actually been diminished. And if you take a look at that, the loan book, you can see that they started to create a little money going into COVID, but then they decided they pulled back. It makes sense that they pulled back, but this isn't what the data shows, by the way. The data shows that they actually did a pretty large increase, but we'll get into that in a second. But here, the monetary, the green line, it pulls back a bit, about $1 trillion, nowhere near in terms of absolute value, percentage, or size of what the fiscal impulse was. And then it comes back actually up to 2022, where it's basically nothing. It's a zero change to the economy. And then there's a slight drop down as we get into current times. But it is not definitive. It's not defining NGDP. It has no relationship to NGDP. You can just see that from even a rustic point of view. It's got nothing to do with nothing. And then the results of the Fiscal, which is excess savings. This is the savings that is over and above the normal savings that people have done for decades in from their disposable personal income. That's personal income less taxes. And the savings level zoomed up because everyone was just getting just stuffed with money to $2 trillion. That is part of the fiscal impulse. And it is the federal insurance, federal FUPC, the unemployment insurance schemes, PPP, all sorts of things went into this, but well, basically only two major things, PPP and the unemployment insurance scheme. And then only of late is it starting to come off because I guess people are spending money. Now, as it comes off, you can see that this is a gradual slope down, and this is just a return to where zero will be normal. And normal is about 9 to 11% of disposable personal income. So this is excessive. This is not limiting growth. It's not. It is definitely keeps expanding growth because this sharp rise in NGDP is from almost all consumption spending. So as this goes down, they're using that money, and it's a good taximeter, we think, in terms of like understanding of like how much excess is still in the economy as we get into the sort of norm, which we think that this tale is defining. Now, if you look at the total, which is right. I'm sorry, it's right here versus the fiscal. There's just no presence of the monetary. It doesn't exist. So all the discussion about the Fed's doing this, the Fed's tightening, the Fed's easing, the Fed's going to cut like 3 soft landing, hard landing, this island, that island, all the lexicon that's being used to describe what's going on in the economy now is either complete bullshit or it is just ignorant. We at the monetary frontier, we're not the brightest guys. We're experienced. We are smart, but we're not the brightest out there. But people that are far brighter than us are still going on and on about this green line, which cannot be disputed, is a nothing in terms of what's happening for the last 4 years. Now,
So
the
just
other thing
to
is we
hit on that,
modify the green line. Yeah, shoot.
just to hit on that point, George. So I think the point that we're making is that in order for there to be a Fed, you can think of there's two real sources of new money. There's either fiscal deficits or bank lending. And in order for there to be a Fed, the contraction in bank lending has to be about as significant as the expansion of the fiscal deficits. One thing I wanted to ask about on the fiscal side is I believe on this chart you're using net fiscal flows, which means post-tax. But I think you had a point on a Twitter thread or something of there being value to using gross flows as well and ignoring the tax because of how the money was transferred to those that don't pay tax. Do you want to hit on that point?
Yeah, and I'm not sure if I'm not creating a myth myself by going down that road. I mean, net is net. That is the amount of money that the government receives in tax and other costs, and that is what they're sending out. But it's probably beyond my means. I don't know. Maybe Riddick, you got an idea on this, but there's underneath this line there is a massive just redistribution of wealth and the creation of wealth, or at least the reduction of loss, whereby the vast majority of those who receive this fiscal impulse are on a tax basis that are close to zero, while the vast majority of norm, like discretionary mandatory, if the economy's balanced, it has to by definition be going to the average taxpayer basis. That's the recipient of the largesse, which means it's not a largesse. So if the fiscal impulse is going to via federal unemployment insurance programs and are to small businesses from PPP, the local bar or whatever, is not really doing that great anyway, and they're sole proprietors and so on, or even the Uber driver, we're getting PPP. If that's the case, it has gone to this has probably been the largest flow in terms of going to the lowest tax bracket in American history. If you think of the World War II fiscal impulse, which I say was the last time we had a large impulse like this, it went off to Ford and went to armaments, to arms guys. It really, the only part of it that went to the normal man was the pay for the soldiers, which I don't think was a great deal. But it was war. This one is to really the lower strata, the lower two quartiles of the U.S. economy are the U.S. people, which undoubtedly has a huge effect, both in terms of maintaining momentum, that excess savings, and so on. But we have to do more work on that to try to figure out how to quantify it versus just a discussion. Oh, one thing on the screen line with the monetary impulse, I was sort of in a blind alley until Riddick figured out a modification that has to be done to that. Riddick, can you outline that?
Yeah, sure. So in that, so this is pulled directly from the H8, which gives a weekly update on the aggregate U.S. banking system's balance sheet. We pulled directly from bank loans, like the total aggregate loans number, and that actually includes all of the PPP loans that were made at the beginning of COVID. And our view is actually like those loans, even though they fall under bank lending, are actually still just an extension of the fiscal impulse because those loans were essentially guaranteed by the government. So we actually removed those loans to isolate specifically bank loans that were made kind of under the purview of the Fed and by the bank's own volition, with the banks like taking into account their own risk and reward. So the monetary impulse number that we get here is just those loans, meaning excluding the PPP loans. And when we do that, I think it's very clear that there's been almost no contraction in bank lending, certainly not large enough to counteract the fiscal impulse.
Yeah, and that number, since the PPP is up in the fiscal impulse line up here, this number has to net out such that the total is towards zero for the Fed to have any sort of effect. Even if this was only drawn down to $1 trillion, that still shows that the Fed is not the dominant or even an important impulse at this point. We can watch on this. We're all set to like see this green line, take off up here and this line go down and to show that norm has returned. But I don't think that's likely for at least the next year. What do you think of that, Riddick?
Yeah, so that's actually one thing another thing I wanted to ask is what kind of the end game for these impulses looks like, or what our forecast could be, specifically in the context of savings. So the red line, as you mentioned, is specifically excess savings, meaning over and above what households would be generally saving kind of in a pre-COVID time. And so that number is drawing down, but when the red line gets to zero, that just reflects that savings are back at a norm. But if it kept drawing down below that, I guess what I wanted to ask is, where would this level of excess savings need to get? I guess how much below zero for the conditions to be like set up for a downturn?
Good question. I think it's a matter of classification almost, is that if excess savings go below zero, what ain't excess anymore? So we retire the whole notion of excess savings.
Yeah.
We're now just into savings.
Yeah.
And actually, the United States in the past has shown a 180 to what you just said, is that if the economy gets into trouble and people start to get fired and everyone gets scared, savings go up. This is of course the dilemma that Keynes points out.
Yeah.
The whole point of an active economy is to give people confidence and also the money so that they go out and don't save, but go buy a car. So I would think that first we retire this excess savings notion. It's it's almost served its purpose. It's related to COVID, and we get into like what is the non-COVID considerations for the savings. And I wouldn't be surprised that it actually starts to shoot up if there is a problem in the economy as sort of the first sign of possible decline, or actually the economy has entered in decline. We're just not noting it yet. And then if it drops, it might actually end up being perversely a sign of overconfidence And like, why the hell are we saving anything? We're going to go buy a house. We're going to buy a car, a boat. We're going to go have fun because times are so good. We've licked the whole problem of any sort of recession downturn. So we're not going to save anything anyway, because we'll always come up with something.
Makes
Um,
sense.
so I think that, and that's just standard Keynesian type ideas, but it is how it was before the GFC, before 2008. Savings was an inverse indicator of the strength of the or weakness of the economy.
Makes sense. Great. Is there anything else you want to hit on this chart before I think we can move on?
No, I think the first the numbers just
Yeah.
should be that's 4 trillion, 4.5 trillion, that's 5 trillion. That should be brought to home. And then I think the landing that people are talking about, this is
Yeah.
it. From December 2022 onwards, the fact that these lines are right on top of each other, i.e., that the monetary policy is pretty well net zero. This indicates that we are normalizing. So this is no longer. I think we're no longer a COVID economy, is what I can say. But the spend for COVID remedy and then other stuff that politically was added on was so large that the digestion of that will take place such that this line is not like right up over like 500 billion or a trillion. It's still way up here. So I think that has to be acknowledged, but I think we're normalizing.
Great. Makes sense. Cool. And then the next thing I wanted to talk about was, I guess, connecting these ideas about the impulses to the market action. Actually, no, sorry. Before we get to that, um, this is, I think, one way that we can triangulate what we're seeing with those monetary and fiscal impulses to the conditions in the labor market. And we think that initial claims on a weekly basis, not seasonally adjusted, is sort of the best way to get that pulse of labor market conditions. And right now, and we like to use heat maps, which George will explain in a second. But right now, in the very bottom right corner is where we're getting data for 2024 so far. And there's still no indication of a meaningful pickup. In fact, the most recent week had one of the lowest, seasonally adjusted claims in all of history. So George, if you want to hit any points home here.
Sure. First of all those who suffered my prior renditions of this heat map, you should be thankful if you do value it to Riddick, because he has reformatted this so that it's perhaps more readable. The reason this is a heat map, and the reason we have these colors, which we purposely set out to be not related to like bigger and better, red and yellow that you usually see. Well, that's why they call it heat maps. Is to show uh, a overall pattern so that you can just look at it and go, oh, blues here, reds are here, the reds are up and down. And here that we have something going on in week 28. This used to be the auto refit week, but it gives you a good overall view, and then you can drill down, and then rather than trust in, and I don't trust them. I'm very leery of any use of seasonal adjustments right now. I think they're political. I think it's of all the labor series, all the labor information, initial claims are the hardest to manipulate through seasonals. But I think it's just done as a matter of course with monthly data. So I use non-seasonals, even though initial claims are hard to manipulate. And then if you read from left to right at any one week, and this is the second week in the year, this gives you a good idea of the seasonal impact. In other words, if it was like red here and now it's whitish blue, it means that there is no seasonal. That yet, if you did the seasonal analysis at this month or that month, you'd be picking this up to adjust this upwards. So this is where the value of using this type of mapping. And then you read up and down or down to up to get the progression of the year. The only conclusion, which many are making right now, is that this is a unique historical event where initial claims, which are only for establishment companies, so a lot of people are trying to make a lot of that hay, but establishment companies are established. I mean, they're there, they are established, and they're very big. Is at an all-time low, probably. And if you were to adjust this for labor force growth, probably ever. Even the concept of initial claims, if they're down like 200 years ago, this would be an all-time low. This goes back to 1962 as the data. The main point is like this cannot be low like this, but for a very strong U.S. economy. It doesn't matter how many guys are into like special, I made 15,000 a month on my secret gig work, or all the stuff you hear that is not captured with establishment data. It is impossible for the establishment data to go off in like this massive economic boom, especially when the fiscal impulse and the remedies that the U.S. government put in were for the lower non-establishment workers. Like most of the guys who received a lot of the money were not out there making the $100 an hour or 90 bucks an hour that the most senior guys make in a Ford plant or something. I think. I don't know if that data is right, but it is impossible for this to operate in a separate universe. They are one and the same. So you can only come to one conclusion, is that the U.S. economy is not only strong, but has been pretty well amazingly strong since we showed signs of pulling out of COVID in 2021. And that's maintained all through 2022. So if you were not watching this, you could go off and babble about whatever you want to about the economy, recession, soft landing, going up, going down, Fed, blah, blah, blah. But if you watch this, none of it's synced. There's only one conclusion to make of this, is that up to each time these initial claims came out, the economy was unusually strong and robust. And that then went into 2022, and that went into the first couple of weeks, and we'll watch this closely in 24. This also shows that Powell himself and anybody related to the Fed, and most of the governors came out in first quarter of 2022 in almost an apology, saying, "I'm sorry, but we got to like really give it to unemployment because that's our main transmission channel to bring about a tightening, because we got to beat this inflation." Yet you can see from here's 2022, not a sign of what the Fed professed was going to be their main transmission channel was altered or changed, given the typical monetary economic understanding, even by the Fed, such that they don't talk about employment anymore. They just let's just shove it away because it's sort of embarrassing. But any rational person would conclude that there is no Fed policy, because employment is a major transmission channel for the Fed, are signs of it being effective. So if this is not rising, then it can only mean that Fed policy is not effective. And of course, we get a little, I don't know, clever and say all sorts of scurrilous things about the Fed, but it is certainly not effective. And there's no reason to see any change in the Fed such that will change for this year. As far as looking at that fiscal impulse, and then what this is the results of, there is no effective Fed right now.
Right. Yeah. I think that's the main takeaway from initial claims. And this comes out weekly. And, for the last several months, it's just been like almost it's been a nothing burger in terms of every number just comes out kind of secularly strong. And I think that reflects the ongoing fiscal impulse. But yeah, I think that's the main takeaway. I think we can move on to the next kind of piece of this, which is connecting this to how bonds and stocks are doing. So I'll get to that one real quick, but I have this chart to show what's happened with the S&P through the SPY ETF, and then long-term treasuries through TLT. And so the call that George has been making for however many years now has been to express a view on a strengthening kind of nominal economy by being long the S&P, which stocks have to ultimately reflect nominal GDP, and then being short bonds as treasuries normalize to 5 or 6%. And since about 2022, since the Fed initiated its attempted tightening, that bet has paid off substantially well and better than being long either individual asset classes. Um, so that with that little bit of context, I think one thing I wanted to do. So in this chart, we have the S&P, which is the blue line, the S&P 500 index, and then the red line is the 10-year Treasury yield. What's happened with the market action since 2022. And I think there's sort of four periods that I would divide this into. And one thing that we noticed here is that the correlations in this period have tended to be decently, strongly positive between bonds and stocks, which we wouldn't expect generally and going forward. So the way that I would kind of describe it is since 2022 until about October of 2022, there was a move higher in bond yields and a move lower in stocks. And then from then to about mid 2023, stocks substantially outperformed bonds. So this is a very strong, solid period to be having this bet. And then in the third quarter of 2023, stocks fell and bonds went even higher. So this is similar to what happened in the first 3 quarters of 2022. And then in the last quarter of 2023, there was a very strong, just like broad asset rally where bond yields fell substantially and stocks basically reached their all-time high again. So George, is there anything you want to describe about how this, like, just anything you want to say about this market action over the last 2 years, and what's been going on with the correlations and such?
Yeah, definitely. Of course, it always it ends here. This is what it's all about. The positive correlation that's between U.S. Treasuries and risky assets, especially popular indices like S&P 500 or Dow or whatever, is perverse. It's just untenable. It will not last. It cannot last because the entire underpinnings of how the United States economy works are going to chaos. So if you go to the chart you first started with, Riddick, you can see that the S&P outperformed bonds since 22. But if you look at like the actual performance, S&P's only come to break even to where it was after that 2021 rally, and bonds have really carried on, as you would expect with an NGDP of 4, 5, 6, 7%. Now, this is not tenable, and the reason I explain to myself, I explain it, and Riddick, give me a challenge if you think otherwise. I think that the S&P is only sort of back to where it started at the end of the 2021 rally, is solely dependent upon the popular meme of the Fed being powerful and that the Fed is tightening, and the Fed, whatever the hell the Fed wants to tell you, is the whole reason for why these the equity returns have been lackluster for right till 23, and even from 23, you still see these sort of like oh my gosh, the Fed is tightening, the Fed is going to do this, the Fed. So I don't want to be long equities. While the same effect in terms of perhaps the larger overall market that is most dependent upon NGDP, which is bonds, you can see that basically has ignored the Fed. It's just like it's just been a really large move downwards. So the question
Just on that point, George, would you say that the drawdown in bonds is ignoring the Fed, or is that not a reflection of the Fed's tightening?
No, it has nothing to do with the Fed. And that's a good question. That's a softball pitch, obviously, but it's a great question. Is that bonds will always be defined by NGDP prospects or what has happened in the last, say, year or so to get to where you are now. If NGDP is on a roar upwards and it's thought that it will continue with some strength, bonds will never go up. They just won't. It's an impossibility because the relationships between the economy defining the bond yields. Now, in this case, this is tilt. This is the long bond. So this escapes some of the crap that's going on about almost rigging of U.S. Treasury 10 years, which we'll get into later. And it's sort of out in the pure space of like, you can't really screw with a 30-year treasury yield. Or another way of saying is the 30-year treasury yield is probably the real risk-free yield for the 30-year area, or close to it, or not as altered by the Fed and other rates, other maturities. So this is honest. This is honest. This is also, if you want, a curve trade of sorts. Like this is a I don't know, 15-year duration,
Yep.
and equity is about a 6 to 7 year duration. So this is receiving the wisdom of the Fed in terms of what's going on in treasuries and the economy and what the Fed's doing at that space. Well, this is sort of like it is set free and doing what it should in terms of pricing the U.S. economy and risk free. But the main story is that this is probably okay. We've had a nice rally. November was fantastic. It was wild. 23 was great. I can take, with the monetary frontier, call this, why aren't we bright? But what we're saying is that this is very tepid and is not a relationship to the US economy that would be the norm. And it's based solely upon the Fed myth, propaganda machine, popular views of the Fed, which we have shown above is just not valid. So the right question to ask is, given the Fed's change and what the Fed's doing and the fiscal input, where should equity be in relationship to that? I would offer, I have stated pretty emphatically that it should be, off this chart. It should be up like 30-40% by now, given what the fiscal impulse is and the neutrality of the Fed, like the non-event of the Fed.
So two questions on that. The first on the S&P reflecting NGDP. Is there anything to be said? And I know you've talked about like earnings kind of evasion or reporting. Is there anything to be said about how, at least in the current composition of the S&P, either the companies don't themselves really reflect like US NGDP, or the way that they report their earnings don't reflect NGDP? Could you elaborate on that idea?
Sure. The majority of the largest weightings in the S&P 500 are no longer hanging their hat on earnings. They don't give a shit. Like if earnings go in half for Bezos, or if earnings go up half, actually, if the earnings go up 50%, that's a pain in the ass for Bezos. That's a tax event. That's all sorts of a ruckus in terms of like what to do with this increased wealth. When do we book it? How do we book it? What do we do? It's a pain in the ass for him. But if Amazon earnings were to drop 50%, it'd be a bit of a ruckus. Maybe he gets a new boss and such like that. But the major stakeholders in Amazon really aren't focused on that as they were like 20 years ago or 30 years ago. When Amazon started out, Bezos had to go on and on and on how he's saying earnings was not his focus, that he just wanted to break even, that what he wanted is market share, a Japanese story. And every quarter, the Amazon earnings did not disappoint his concern. They were sort of shitty, but the market share ever increased. So that's where the focus of Amazon was. And maybe to this date, it's still there. But certainly Jeff Bezos doesn't care if Amazon earnings are tripled, or actually he does care. It's a pain in the ass for him. Or if Amazon earnings are down in half. And if you take this very rough idea, it's the same for every company. Microsoft. Bill Gates doesn't really care about quarterly earnings of Microsoft. He cares about the strategic earnings of Microsoft. That goes for Google. All the major weights. Perhaps the only guy who cares about earnings right now is NVIDIA, for obvious reasons. The new ones on the block, and there's like where all these other guys were about 20 years ago. And the other thing is that these large weighted companies are more often than not the child of venture capitalists and private equity, where they really don't care about the earnings. As a matter of fact, they sort of would like the earnings managed over a 5-10 year view, because that suits their capital and their funding process for their capital backings. Now, those guys are less important to the likes of Microsoft or whatever, but the concept is still there. And then the final thing is that the majority of companies that have access to offshore or global markets have all gone down the rabbit hole of various tax schemes using patents were transferred to Irish companies. Then that Irish company charges the company that's generating the market flow a big chunk for IP, to the most that they possibly can. And then they hold that as a cash asset. Then they might want to wash it. It's almost like it is money laundering. And then they move it off to a Dutch Antilles type of locale. Then they move it back. They're paying. And New York Times did a fantastic article, of which none of the editors or reporters that I'm aware of attached to that article did very well after that fact, exposing Apple was only paying about maybe 20% of the taxes that they should be paying as per law. That started a movement in Congress, and it's been happening every 7, 8 years to get that cash offshore, onshore. They're going to forgive and forget, just get that money onshore, and so on. But the Irish GDP, which is extraordinary, despite the fact that Ireland is probably in a recession right now, despite that massive surge in Irish GDP, is really just tax flight money. It's all in the double Irish Dutch sandwich, or various other ways to describe it. And it is all the Irish companies of Google, Amazon, pharmaceuticals do this. Anybody with intellectual property that can be charged does this. So what that ends up with is probably S&P earnings are really very much understated for both the founders' inclinations and also for the likes of the double Irish Dutch offshore tax schemes.
Makes sense. And then if that is the case that earnings are understated, then how does that kind of square with the idea that the S&P should still ultimately reflect NGDP if, let's say, like the S&P's earnings are, always understated by 50%, then
well, let's take
yeah.
let's take the extreme. Well, it's not even extreme. Like Buffett's favorite companies don't pay any dividends, and they always retain earnings. So if those
Right.
earnings are there, they're always being retained somewhere. So they're just being retained in the Dutch Antilles or someplace, or Grand Cayman. So it doesn't really matter in terms of the value of the company. What the value of the company will be based upon the growth in its markets or the decline in its markets. Now, as companies get more global, obviously what happens in China, it might be of more importance than what happens to Apple, than what happens to the US buying and selling of iPhones. But still, the iPhones in the US is the basis of most companies. And there can be no doubt that NGDP is expanding. So there's no doubt you can't alter, you can't give up any other alternative. That means the markets and the profit, the raw earnings, the cash flow, however you want to call it, is tracking NGDP. And I say that that's not being expressed in equity prices.
Makes sense. Great. And then on the bond side, I think what I want to do is, in order to prevent this from becoming too long and using up all of our ideas in the first video, save the discussion of the risk-free curve for our next video, but just preview it here with a couple of questions that I wanted to hear your thoughts on for bonds. So the first thing is, on this chart, you made the point that the drawdown in TLT and in long-term treasuries is a reflection of the reality of NGDP. However, if we just look at, and we can just pull up, if we just look at what happened with Treasury with a 10-year in 2021. So at this point, I think, if I'm remembering correctly, nominal GDP growth was very high, and the fiscal impulse had begun to make its way, and yet the 10-year remained under 2%, which I think, looking back, it clearly was a mispricing, but at that point, that's what it was for the entirety of the year. How would you explain? Is this a function of the Fed's QE? Why do you think the bond yield was as low as it was, even though nominal GDP was expanding really rapidly?
Well, it is a function of the Fed QE, which should not be seen as an ease. QE is just the Fed buys a shitload of treasuries. which they fund, by the way. It's a complete wash in terms of how monetary economics work. But they do buy a lot of treasuries. They do convert a lot of zero duration to long duration in their balance sheet. Now, that for most is enough reason why rates should be low, but that's really not what's happening. What's happening is the Fed, if you're going to go buy 8 trillion of something, you get the right to set the market rate, like to set the price, as long as it's not above the treasury rate or the risk-free rate. Because to do that, you have to short, and the Fed can't short, but they can definitely buy. So this rate right here for U.S. Treasuries at 180 is because a couple bright guys at the Fed decided that that's what they're going to pay. And then when QT hits, where they actually have to start thinking about selling, as long as they don't use up all of QE and take away that effect of that 180, or even probably more importantly is what was done in 2020 with the COVID QE to 21, that's it. It's like, that's what the Fed deemed. So these are administrated rates. They're not it's not a demand supply question. It has nothing to do with the economy. It has nothing to do with Fed policy. It doesn't do any ease, doesn't do any tightening. It's just to basically fuck up price discovery and set it at an undue low rate. I don't know, to hide the treasury market. I really don't know what they're up to. It's stupid.
Right. So the idea is with QE and with these balance sheet operations, because it's a wash in terms of the private balance sheet. When the Fed does QE, it dislocates the treasury curve from what the true risk-free curve is, which we think always represents or always reflects the U.S. economy. So that's on the QE side. And then the other question I had that would kind of preview what we'll get into in the next video is on the Treasury's supply side. So this is the discussion that makes its way every quarter about the quarterly refunding, Treasury supply, bills issuance versus bonds issuance. So what I wanted to ask there was in these last two periods. So in the third quarter of 2023, there was this talk of there was a strong rise in bond yields and equities fell. And I think one explanation that a lot of people gave was that was driven by the composition of treasury issuance. And then when bond yields hit 5% and then quickly came back to 4%, that was because of more kind of dovish issuance, if you want to call it, meaning more bills and less bonds, et cetera. So I guess we wanted to ask, how do you think, treasury supply, what Yellen is doing, how do you think that affects how that affects bond yields, and if it does or if it doesn't?
Okay, Riddick, you're now throwing a hardball at me, which might do damage to me. I will say that what you're looking at here right now, first of all, if you look at the blue line dropping to the lows and the red line here, give me the cursor back here, Riddick, for a second.
Okay, I think you should. Are you able to move it?
Oh, there you go.
Yeah.
Okay, the blue line, S&P dropping like all hell to here, and the red line, which is bond yields going up, which is almost like a perfect one correlation, positive one correlation.
Yeah,
can only be a fiction. It can't exist. If you look at like 200 years of economic, I mean, hell, if you go back to like Roman times, if you can get the data, this does not happen. The risk-free rate and the risky rate, levels do not have a one correlation. It can only be the results of market manipulation, whether it's the Fed, maybe there's a secret QT that went down beyond what the scheduled 90 billion, maybe not.
And just to clarify, in this period, the correlation is one, and the reason why they're moving in opposite directions is because we're looking at the yield of the 10-year and the level index of the S&P. But so in this chart, for them to move in opposite directions would mean they're positively correlated, and then for them to move in negative in opposite directions, like in this last period, means that they're negatively correlated as we would expect. But yeah, continue.
Right. That's a good point. Bond yield go up, prices go down. Okay, got that. And you're right. when you see a formation like this in such a time, when you have some character coming out within a minute of the peak of the U.S. Treasury 10-year yield saying, "Oh, the easy money has been made, and I'm now going to sell," that that's criminal. I'm telling you, in 1990, 91, anybody who says such stuff, or anybody who has trades, or anyone who's connected, that's tippy tipper type stuff. That is a crime. And in the 90s, you got a free visit down to Washington, D.C., and you got the heck scared out of you as you had to prove, not the opposite, you had to prove you were not a criminal. It was like SEC violations as such, you're guilty until you prove otherwise. That this is not thought of right now. That is really a head scratcher for me. I really don't understand why there isn't, why I seem to be the only person, maybe because decent people don't hang out on Twitter and do stuff like this. But I don't see anyone else just calmly saying, "Oh, that's a rig. That's a market manipulation. It worked." And because it works so well, because you can see, there was a few quarterly refunding announcements here and there. And then it was just like here in midsummer when suddenly it became QAR all over, and there was like it's not like it's almost like the characters who did this hired a PR firm and they got a talking points and they shared it. This happens, yet there's large QRAs well before that, but why now? And then here it's gone total reverse. And right now we're already getting fellow travelers, connivers, the ignorant, I don't know, whatever they are, all set to go for stage 2 on the QAR. I cheekily and maybe insultingly call them flying monkeys. They're all set to go at it again. And why not? I mean, the likes of Citadel had twice the return almost of the likes of Millennium. Millennium's very reluctant to mess with markets. They had a bad time with mutual fund timing a while ago. They are really a clean shop as far as I can see, and I've observed for a decade plus. A lot of these new HFT guys of the likes of Citadel, who are now making like double the return that a Millennium's made, with the same sort of intelligence, the same sort of trades, it's telling, I think, that there's sort of a Wild West wilding that's going on. Why can I do this? Because I have 30 billion under management. That's why I can do this. I don't think I've said something that could be sued, but anyway, that's what I think.
Yeah. So I think that's hopefully previews kind of our next discussion about what the true risk-free curve is and whether the treasury curve reflects that or not, or whether NGDP reflects that or not. So I guess just to like tie all those things together, and again, we'll get into this more in depth in the next video. But so your point is that for treasury for the treasury curve, QE matters for setting those rates at different maturities, but treasury issuance and issuance of bills versus notes versus bonds doesn't. Is that how you is that fair characterization?
Yeah,
And yeah,
and if we look at the supply, if the treasury issuance is not as we experienced a couple of years ago, because of the large deficit, suddenly large deficit, and if that large deficit is having any impact on the economy, which without any doubt it is, it's the economy is just in a moonshot, then it doesn't make any sense that the funding for that deficit spend would have any detrimental impact, either in terms of where it lies, all 3-month bills or all 30-year bonds, or the size of it, on the cost of risk-free rate. Because in many ways, that cost has already been determined by those who receive that money, and they're a couple of weeks, a couple of months ahead, and they've already determined the risk-free rate. Like what is happening in the new home market in terms of financing a new home is far more important to this rate than whether there's like 800 billion of U.S. Treasury 10 years or there's only 2. In fact, I'll say it's not more important. It is important. The size of and the composition of the quarterly refunding announcement has no effect. Now, it does have a big effect on sentiment, as we can see in this graph, where they jammed U.S. Treasuries up, and they'll do it again. But as far as macroeconomics and any sort of bond understanding in terms of fundamentals and history for the last 30, 40 years, it has no effect.
Great. Yeah, that makes sense. Cool. So yeah, so just to recap in this discussion, we hit on the ongoing fiscal and monetary impulses, how we're getting to those numbers, where those numbers need to get to in order for us to come off of this view that the U.S. economy remains in an unusual period of strength, and that strength should be reflected in a continued kind of up rise in the S&P to our call is 6,000 by the end of this year, and then the 10-year treasury yield to get to 6%, both reflecting a negative correlation between those two assets and both of them reflecting a very strong economy. And then we previewed the role of supply and QE in dislocating the treasury curve from the real risk-free curve, and we'll hit that in more depth in the next video. George, is there anything else you wanted to say before we wrap this up?
No, these are our main points, to the point of, like, I think we're boring people, but anyway, this is it. I don't find 5 trillion boring. It's just a fact. The elephant entered your backyard and won't leave. But we will continue to keep an eye on it. We'll do our very, very best to find out when it turns otherwise. And no doubt we'll create all sorts of different views and ideas as we go forward. Please follow both Riddick and myself on X, and please go subscribe to the Monetary Frontier if you think this is of use.
Yep. And if you have any questions, you can either comment on the YouTube video, you can comment on the Substack, you can directly shout one of us out on Twitter. Anyway, works, and we'll be happy to think about those questions. So yeah, thanks everybody. Until next time.
Thanks a lot for your time.
Great.